you don't lose money when the trade goes against you. Very often, you lose money the moment you decide to enter. That sounds strange, doesn't it? The loss hasn't happened yet. The chart still looks promising. Your stop hasn't been touched. But something is already wrong. The decision was made from impatience, not evidence, and the market has a way of exposing that mistake later. Have you ever entered a trade and felt relief the second you clicked the button? Think about that for a moment. Why relief? Relief from what? Usually, relief comes from ending uncertainty. The trader wants to be in the move more than he wants to be right. That's where the first entry mistake begins. Mistake A1. Entering before confirmation. The market rarely rewards anticipation as consistently as traders hope. A setup starts forming, price approaches a level, and suddenly the mind begins spending profits before the trade exists. But what are you actually buying at that moment? Evidence or expectation. When you enter before confirmation, you are forcing the market to prove you right. When you wait for confirmation, the market does some of the work for you. The difference seems small. In practice, it changes everything. A trader who enters too early often faces immediate pressure. Price hesitates, doubt appears, risk increases. Then decisions become emotional. One premature entry creates 3 additional mistakes. The solution is simple, though not easy. Let price reveal its intention first. Let strength show itself. Let weakness become obvious. You are not paid for predicting. You are paid for positioning. Now consider another question. Have you noticed how the trades you want the most are often the ones you should examine the hardest? That leads to the second mistake. Mistake A2I, entering because you need action. The market can remain quiet longer than your emotions can remain patient. After a slow session, a missed move, or a string of losses, the urge to trade becomes powerful. Suddenly average setups begin looking exceptional. But the chart hasn't changed. Only your emotional state has. This is dangerous because the mind becomes a salesman. It starts creating reasons to justify a decision that was already made emotionally. Action feels productive. Waiting feels passive. Yet in trading, patience is often the active decision. The professional understands that cash is a position. The amateur feels exposed when not involved. Can you recognize the difference in your own behavior? Mistake pen 3, entering far from the risk point. This mistake receives less attention, but it quietly damages consistency. A trader sees momentum, becomes afraid of missing the move, and enters after price has already traveled a significant distance. Now the stop must be wider. Risk increases. Reward potential shrinks. Notice the chain reaction. Poor location creates poor risk. Poor risk creates emotional pressure. Emotional pressure creates poor decisions. A great idea entered at a poor price can become a poor trade. Before entering, ask yourself a simple question. If I'm wrong, where should the market prove it? If the answer is unclear, the entry is probably unclear as well. The market offers opportunities every day. The challenge is not finding trades. The challenge is finding entries that align with evidence, patience, and risk. Because the quality of an entry doesn't just determine how much money you might make. A surprising number of trading problems begin before the trade has had any chance to succeed or fail. The trader blames the exit. He blames the market. He blames volatility. Yet if you trace the chain of events backward, the source is often a single click placed at the wrong time, in the wrong location, or under the wrong conditions. That's worth thinking about, because once you're in a trade, your options become limited. Before entry, you have complete freedom. After entry, you are reacting to what happens next. Have you noticed how one poor entry immediately creates new decisions? Price pulls back slightly. Now you're wondering whether to hold. Price stalls. Now you're questioning the setup. Price moves against you. Now you're adjusting risk, reconsidering targets, and managing uncertainty. One decision has produced 5 more. A precise entry does the opposite. It simplifies the trade. It reduces the number of decisions required after the position is open. The market may still prove you wrong, but at least the trade remains clear. This is something many traders overlook. They treat entry as a starting point. In reality, entry is a filter. It determines the quality of every decision that follows. Think about 2 traders looking at the same opportunity. One enters the moment he sees potential. The other waits until conditions align with his criteria. Both may be trading the same idea, but they are not trading the same position. The first trader enters with uncertainty that still needs resolution. The second enters after some of that uncertainty has already been resolved. That difference changes everything. Why? Because every trade contains unknowns. The goal is not to eliminate uncertainty. The goal is to reduce it before committing capital. A well-timed entry accomplishes exactly that. When evidence strengthens before entry, the trade begins with greater clarity. When evidence is weak, the trade begins with questions. Questions lead to hesitation. Hesitation leads to inconsistent decisions. Cause and effect. The market rarely punishes traders all at once. It usually starts with a small compromise, a slightly early entry, a slightly rushed decision, a willingness to accept conditions that are almost right. The compromise appears harmless because nothing bad happens immediately. Then the trade becomes harder to manage than expected. Not because the market changed, because the entry changed the nature of the trade. Have you ever entered a position and felt like you were working too hard afterward? Constant monitoring, constant adjustments, constant interpretation of every candle. Often that effort is a symptom, not the problem itself. The real problem occurred at entry. A strong entry creates a situation where the market has room to behave normally without forcing the trader into action. A weak entry creates a situation where normal market movement feels threatening. The difference is subtle, but the consequences are not. This is why experienced traders become selective, not because they enjoy waiting, not because they seek perfection, because they understand that entry quality determines decision quality. Every trade asks a simple question. How much uncertainty are you willing to accept before you commit? The answer matters because once the position is open, the market takes control of the conversation. And when a trader consistently improves entry quality, something interesting begins to happen. The trade itself doesn't necessarily become easier. What changes is the number of problems that never appear in the first place. A trade can be correct in direction and still be a poor bet. That idea confuses many traders because they judge entries by whether the market eventually moved their way. But the market moving in your direction does not automatically justify the price you paid to enter. Price matters. In fact, the mathematics of a trade begins the moment you choose an entry. Every tick above or below that point changes the relationship between risk and reward. Consider what happens when a trader chases a move. The setup may still be valid, the trend may still be intact. But after price has already traveled a significant distance, the mathematics begins to change. Why? Because risk does not expand and opportunity expand equally. As price stretches away from an ideal entry area, the distance to a logical exit point often increases. At the same time, the remaining potential movement may stay the same or even shrink. The trader is now risking more to make less. That is not an opinion. It is arithmetic. A trade that offered a favorable balance between risk and reward a few minutes ago can become an unfavorable proposition simply because of where the entry occurs. Have you ever entered a strong move only to discover that even a winning trade produced less than expected? Often the explanation is hidden in the entry price. The market may have delivered exactly what the setup suggested. The problem was that the trader paid too much for participation. Think of it this way. A business owner would not buy an asset at any price simply because it was valuable. The purchase price matters. The return on investment depends on the relationship between cost and opportunity. Trading is no different. The market constantly presents opportunities, but every opportunity comes with a price tag. The higher that price tag becomes, the more future movement is required to justify the risk being taken. This is where small entry differences create surprisingly large mathematical consequences. A slightly better entry can reduce risk substantially while preserving most of the opportunity. A slightly worse entry can increase risk substantially while preserving very little additional opportunity. The percentages begin shifting against you, and because trading results are built from hundreds of trades, these small disadvantages accumulate. One trade may not reveal the problem. 10 trades might not reveal it clearly. But over a large sample, unfavorable entry pricing quietly erodes performance. The trader sees acceptable win rates and still struggles to grow. The reason is often mathematical rather than directional. The gains from winning trades are not large enough relative to the losses from losing trades. The entry created that imbalance long before the outcome was known. So what should you look for? Instead of asking, can this market move higher? Ask, how much must it move from here to justify the risk? Notice how different those questions are. The first focuses on direction. The second focuses on value. Professional speculation has always been about both. Direction alone is incomplete. A trader who consistently enters at favorable prices gives himself room for error. A trader who consistently enters at unfavorable prices demands precision from the market. One approach allows ordinary market movement to produce acceptable results. The other requires exceptional movement just to compensate for the entry. And markets do not provide exceptional movement on demand. This is why experienced traders often spend more time evaluating location than prediction. Not because prediction is unimportant, because even the best prediction loses much of its value when the mathematics of the trade have already been compromised. The market is always speaking before it moves. The problem is that traders often try to enter before the message is complete. They see a level, a pattern, or a setup, and they focus on what they expect to happen next. Meanwhile, the market is still in the process of deciding. That distinction matters. Because an entry is not just a bet on direction. It is a judgment about what the market is currently doing. Have you ever watched price reach an important area and immediately assumed you knew what would happen? The market rarely rewards assumptions for long. A level by itself means very little. What matters is how participants behave when price reaches that level. Are buyers becoming more aggressive? Are sellers losing control? Is price being accepted or rejected? These questions reveal information that the chart pattern alone cannot provide. The market is an auction. Every movement higher or lower is the result of participants competing to establish value. When buyers are willing to pay increasingly higher prices, the market rises. When sellers become more aggressive than buyers, the market falls. Price is simply the visible result of that process. Understanding this changes how you view entries. Instead of asking where the market should turn, you begin asking whether the behavior of participants is actually changing. That shift is important because markets often visit significant areas without reversing. They often break through support that looked obvious. They often stall beneath resistance that appeared weak. Why? Because the level itself is never the complete story. The behavior around the level is the story. A trader who enters purely because price arrived at a location is acting on a static observation. A trader who waits to see how participants respond is acting on developing information. One approach relies on prediction. The other relies on observation. And markets continuously provide clues for those willing to watch. Consider a breakout. Many traders focus on the moment price crosses a level. But crossing a level is not necessarily meaningful. What matters is what happens afterward. Does participation increase? Does price continue to attract buyers? Does the market accept higher prices? A breakout that attracts commitment is very different from a breakout that immediately collapses. The structure may look similar on the chart, but the behavior underneath is completely different. The same principle applies to reversals. A market does not reverse because a line was drawn on a chart. It reverses because the balance between buyers and sellers changes. That change leaves evidence. Momentum shifts. Rejections appear. Follow-through changes. The auction begins producing different results. Those are the signals worth paying attention to. Can you see the difference? One trader studies where price is. Another studies what the market is doing. The first trader focuses on location. The second focuses on behavior. Location provides context. Behavior provides confirmation. And because markets are driven by participation, behavior often carries more useful information than the level itself. This is why experienced operators become patient around important areas. They understand that arriving at a location is not the event. The response is the event. The market reaches support every day. The market reaches resistance every day. What separates meaningful opportunities from ordinary noise is the reaction that follows. Once you begin viewing entries through that lens, Charts stop looking like collections of patterns and start looking like evidence of an ongoing negotiation between buyers and sellers. One of the most expensive habits in trading is answering the wrong question. A trader looks at a chart and asks, "Should I enter?" At first glance, that seems reasonable, but hidden inside that question is a problem. It encourages a search for reasons to participate. Once the mind starts looking for reasons, it usually finds them. The chart begins to look clearer than it really is. Evidence that supports the trade becomes more important than evidence that contradicts it. The decision starts moving toward action before the analysis is complete. Experienced traders often approach the situation differently. Instead of asking why they should enter, they ask why they should not. That small shift changes the entire decision-making process. Why? Because good decisions are rarely built by proving a trade deserves a position. They are often built by trying to disqualify it. Think about it for a moment. If a trade remains attractive after every objection has been considered, the decision becomes stronger. If the trade falls apart under questioning, it was weak from the beginning. This approach matters because markets are uncertain by nature. No chart can provide certainty. No pattern can eliminate risk. No setup can guarantee an outcome. The goal of decision-making is not to become certain. The goal is to reach a point where the available evidence justifies action. Those are very different objectives. A trader seeking certainty waits for something the market cannot provide. A trader evaluating evidence accepts uncertainty and focuses on probabilities. That distinction leads to better decisions. Have you ever noticed how some trades feel obvious while others require a great deal of explanation? That observation is often useful. When a trade demands extensive justification, conflicting evidence may already be present. The decision becomes more complicated because the information itself is more complicated. Strong opportunities do not necessarily look perfect, but they tend to look coherent. The evidence points in the same general direction. The story the market is telling remains consistent. Decision quality improves when a trader learns to recognize that difference. Another mistake appears when traders treat every piece of information equally. Not all evidence deserves the same weight. Some observations are highly relevant. Others are merely interesting. The challenge is determining which information actually affects the decision. A trader who cannot separate critical evidence from background noise becomes vulnerable to confusion. As more information arrives, clarity decreases rather than improves. Good decision makers do the opposite. They simplify. They identify the factors that matter most and allow secondary details to remain secondary. As a result, decisions become cleaner and more consistent. Notice what happens when this process is repeated over time. The trader becomes less concerned with predicting outcomes and more concerned with evaluating evidence. That is an important evolution. Predictions can be right or wrong. A sound decision can still produce a losing trade. An unsound decision can occasionally produce a winning trade. The outcome alone does not reveal the quality of the decision. Only the process does. This is why skilled traders often review decisions separately from results. They understand that a decision should be judged according to the information available at the moment it was made, not according to information revealed afterward. Otherwise, learning becomes distorted. The mind starts rewarding lucky decisions and punishing disciplined ones. Over time, that creates poor judgment. The trader slowly loses trust in evidence and becomes increasingly dependent on outcomes. The market eventually exposes that weakness. A better approach is to ask a different question before every entry. Given everything currently known, does the evidence support committing capital here? Not certainty. Not prediction. Not hope. Evidence. A trader's true entry method is not revealed on an ordinary day. It is revealed on a difficult day. Anyone can follow a process when conditions are clear, opportunities are obvious, and recent results are favorable. The real test comes when the market becomes confusing, when opportunities become scarce, or when recent trades have not worked as expected. That is where professional habits begin to matter, because trading is not a performance measured over a single decision. It is a process repeated hundreds and thousands of times, and anything repeated that often must be built to survive changing conditions. Have you ever noticed how some traders seem to have a different strategy every week? One month they are waiting for confirmations. The next month they are chasing momentum. Then they are trading breakouts, reversals, and everything in between. The market may appear to be the problem, but often the problem is inconsistency. Without a stable entry process, every day becomes a new experiment. The trader is no longer testing a method. He is testing moods, reactions, and temporary opinions. That creates a dangerous situation. When results improve, the trader cannot identify exactly what caused the improvement. When results decline, he cannot identify exactly what went wrong. There is no reliable process to evaluate, only a collection of changing behaviors. Professional operators approach this differently. They understand that an entry process is not simply a way to find trades. It is a way to create consistency in decision-making. The purpose of a process is to ensure that similar situations receive similar responses. Why is that important? Because markets already contain enough uncertainty. A trader does not need to add more uncertainty through inconsistent behavior. When the same criteria are applied repeatedly, something valuable happens. Patterns become visible. Strengths become visible. Weaknesses become visible. The trader gains useful feedback because the process remains stable enough to measure. Without consistency, feedback becomes meaningless. Imagine trying to improve your golf swing while changing your technique every few shots. You would never know what was helping and what was hurting. The same principle applies to entries. Improvement requires repetition. Repetition requires consistency. Consistency requires habits. This is why experienced traders often become less concerned with finding new opportunities and more concerned with executing existing rules correctly. The outsider sees repetition. The professional sees refinement. A small improvement applied consistently often produces greater results than a brilliant idea applied occasionally. That principle appears repeatedly in speculation. Have you ever wondered why some traders remain disciplined even after a series of losses? It is not because they expect the next trade to win. It is because their confidence comes from the process rather than the immediate outcome. The process determines whether a trade qualifies. The outcome determines whether the market agrees. Those are separate things. When traders confuse them, habits become unstable. A winning trade justifies breaking rules. A losing trade encourages abandoning structure. Soon the process disappears entirely. The trader begins reacting instead of operating. Strong professional habits prevent that cycle. They create a framework that functions whether conditions are favorable or unfavorable. The goal is not perfection. The goal is reliability. A process that only works on good days is not really a process. It is a preference. A professional entry routine must function when confidence is high and when confidence is low. It must function after gains and after losses. It must function when opportunities are abundant and when opportunities are rare, because if the process changes every time circumstances change, the trader eventually becomes dependent on favorable conditions rather than disciplined execution. One of the quietest mistakes in trading is believing that good trade management can compensate for a poor entry. It sounds reasonable. If the trade starts badly, manage it better. Adjust the position. Give it more room. Exit early if necessary. Find a way to recover. But there is a problem hidden inside that thinking. Trade management works best when it is refining a good situation. It works poorly when it is trying to repair a flawed one. The difference is important. A strong entry and a weak entry may look similar during the first few moments after execution. Yet they place the trader in completely different situations. One begins with alignment between the trade idea and the market's behavior. The other begins with tension. And once tension enters the trade, management becomes more difficult. Have you ever noticed how some positions seem to require constant intervention? The stop gets adjusted. The target gets reconsidered. The entire trade seems to demand attention. Meanwhile, other trades appear to manage themselves. The market does not become easier. The starting position becomes better. This is where many traders misunderstand the role of management. Management is not designed to rescue poor entries. It is designed to respond to information that emerges after a quality entry has already been established. Those are very different tasks. When management becomes a rescue operation, the trader starts solving problems that did not need to exist. A poor entry often creates these problems immediately. Price is too extended. The market is not behaving as expected. The trade lacks a clear foundation. As a result, every normal fluctuation begins generating new decisions. Should the stop be moved? Should the position be reduced? Should the trade be exited? Questions multiply because the initial entry created uncertainty. Cause and effect. The entry introduces weakness. The weakness creates management challenges. The management challenges create additional decisions. Each new decision introduces another opportunity for error. Notice what happens when traders rely too heavily on management. Gradually, they begin treating entries as less important. The logic becomes dangerous. If the trade goes wrong, I'll manage it. But the market does not reward that assumption consistently. A poor beginning often limits what management can accomplish. The trader is trying to improve a position that was compromised from the start. That is similar to steering a vehicle after choosing the wrong road. Skill may reduce the damage. It cannot erase the original mistake. The best trade management often appears almost invisible. Why? Because the entry already placed the trade in a favorable position. The market had room to fluctuate naturally. The structure of the trade remained intact. Management became a matter of observation and adjustment rather than repair. This distinction changes how experienced traders think. Instead of asking how they can fix weak trades, they focus on reducing the number of weak trades that require fixing. That shift produces a powerful effect. The fewer problems created at entry, the fewer management decisions become necessary afterward. Complexity decreases. Clarity increases. Execution improves. Have you ever wondered why some traders seem unusually patient before entering but relatively calm after entering? The answer is often found here. They understand that effort invested before the trade frequently eliminates effort required during the trade. A strong entry creates options. A weak entry consumes them. That principle appears repeatedly in speculation. Every trade begins by establishing the conditions under which future decisions will be made. If those conditions are favorable, management becomes more effective. If those conditions are unfavorable, management becomes defensive. The trader spends time controlling damage rather than guiding opportunity. One of the reasons traders struggle to eliminate entry mistakes is that the mistakes rarely look the same twice. The chart changes. The market changes. The setup changes. Yet somehow the result keeps repeating. This creates an illusion. The trader believes he is encountering new problems when, in reality, he is often repeating old ones under different conditions. That is why certain mistakes survive for years. They disguise themselves. Have you ever reviewed a losing trade and thought, "I won't do that again," only to make a remarkably similar mistake a few weeks later? The details may have been different. The underlying error was often identical. This happens because traders tend to focus on the surface of a trade rather than its structure. They remember the pattern. They remember the market. They remember the outcome. But they fail to identify the decision that produced the problem. As a result, the lesson never becomes fully understood. The mistake remains active. Consider how easily a trader can justify an entry. In one situation, the reason may be a breakout. In another, it may be a pullback. In another, a reversal. The setups appear unrelated, yet the same weakness may be present in all three. The entry occurred without sufficient evidence, or the entry occurred at an unfavorable location, or the entry occurred despite conflicting information. Different charts. Same mistake. This is why improvement often begins with recognizing patterns in behavior rather than patterns on charts. Charts provide opportunities. Behavior determines how those opportunities are handled, and behavior tends to repeat itself. The market offers endless variety. Human decision-making is far more predictable. That predictability leaves clues. Repeated mistakes often leave a signature. A trader consistently enters too soon. A trader consistently commits capital before conditions fully develop. A trader consistently acts on incomplete information. The exact market circumstances change, but the behavioral pattern remains. Cause and effect. The behavior creates the mistake. The mistake creates the result. The result creates frustration. But frustration alone rarely solves anything. Recognition does.